everyone. Welcome to the KE Report and another daily editorial on Thursday, May 22nd. We are chatting with Brien Lundin. Brien is the editor of the Gold Newsletter, also our host down at the New Orleans Investment Conference this year, November 2nd to 5th. And Brien, let's talk about what's going on in the precious metals sector in terms of the equities. We've been talking about it a fair bit this week, and that's a general rotation of money, seemingly out of some of the bigger companies, also those faster moving stocks, the ones that have been completely outperforming, I guess, the broad spectrum of resource stocks, and money filtering into the juniors. One thing I've noticed recently is a lot of financings being announced, being upsized, being closed by these junior companies for more than just a couple $1,000,000. And we've also been seeing the smaller stocks outperform some of these bigger stocks. So, Brien, in terms of your portfolio, in terms of what you're seeing out there, are you with us on that? Have you seen this rotation of money into these smaller equities, especially in the gold and silver space?
Yeah, Corey, I really have. I was just noticed actually yesterday. I checked one of my major actually portfolio or brokerage account, and it was up, I guess, 10, maybe 15% from last week, which was good to see. But, nothing that I could track by saying, oh, this one position really took off or anything else. It's kind of the rising tide that we're seeing right now. I think one of the big driving factors in the junior market, because it is so speculative, is simply FOMO, fear of missing out. People don't want to be left behind. They don't want to see their friends and colleagues winning without them. So when the market starts to creep up, they get just a bit desperate, or there's a sense of urgency to get involved and make sure you're on the train before it leaves, and make sure you've got the next hot stock, or you're able to find it. So it's a typical market reaction. We've seen it over and over again over many years, and it's starting now in the juniors. The TSXV index is not the best proxy for the juniors because it contains a lot of other small cap stocks, but that index is primarily mining and resource stocks, and it's threatening, if you look at the chart, on a major breakout off of a very long base. So I think it's all coming together. It's not so much gold dependent. Gold over $3,000 an ounce is great for the big miners, and therefore it's great for the juniors eventually. So people aren't as obsessed with where's the gold price going today. You can drop $50 today or $100, and the expectation is it's going to stay over $3,000, which is a really good place to be if you're trying to find and develop gold deposits. So it's a very encouraging, very bullish atmosphere. The wind is at the back of the mining equities right now, and we're just starting to see the kind of a typical rebound in the juniors that once it gains steam, it goes pretty quickly.
Well, Brien, it is nice to see the smaller cap stocks finally getting a bid. To the point you were just making about gold just kind of trending sideways, do you think it's also an aspect where people are just getting more comfortable with the price of gold, that it's not going to be a flash in the pan high, but that it's actually going to stick at these levels, and that's allowing people to move up their models for valuations on, let's say, developers that have an economic study, or people spitballing, what an advanced explorer may have in the ground and what it could be worth? Do you think some of that is just people getting more comfortable with the gold price?
Yeah, great point, Shad. That's exactly it. This move in gold has been so amazing. It was about 14 months ago that we were hoping gold would stay over $2,000 an ounce, and now everybody's pretty confident and comfortable with the fact that gold's going to stay above $3,000 an ounce and probably headed much higher over the years to come. But the key that I think underlies what you're saying is that we didn't really understand this gold bull market for a while. Everything was so Fed dependent. Investors, speculators, everybody just tried to read the tea leaves on a daily basis. What was the Fed thinking? What's their next policy move? Are they going to cut rates or not? Or God help us, are they going to actually hike rates? And we've shifted away from that. People have come to understand that it's not really what the Fed does, it's what all of these other central banks, sovereign authorities, and family offices and big investors around the world are doing. And they're putting their money into gold. And it's a kind of buying that is separate and divorced from the kind of a typical investment market that we're used to, where swings and money flows are determined by the swings in investor sentiment from euphoria to despair and back again. And that's why you have these big peaks and valleys. And a correction is considerable. In a typical market, and even in a typical gold bull market, you would have seen the price test the 200-day moving average at least a couple times over this period. In fact, it hasn't really threatened it over this whole bull market. Even in the post-November election, which was a real correction, it didn't really approach the 200-day moving average. And that, in my mind, is what really makes this market unique, literally unprecedented. We've never seen anything like this before because it's being driven, again, not by investors, but by central banks and in geopolitical strategy, which doesn't have those kinds of emotional swings and sentiment. It's just steady buying and occasionally stronger buying when something happens around the world or when the price gets low enough that that allocation can buy even more of the metal. So it is different. And yes, I think investors have become comfortable with the fact that we're not going to get that 2x4 upside the head by Mr. Market, and have a big sell off. In fact, every attempt by Western speculators to play games in the paper markets, the paper gold and even the paper silver markets to really drive the prices down has been rebuffed, and they haven't been able to do it. So yeah, I think we're in a correction for gold, but that term does not mean what it used to mean, at least for this market.
Oh, this is a bull market. Has been for a while now, with gold just continuing to break out and the big stocks first and foremost leading the way. Now money going down into the littler guys. But Brien, when we talk juniors, I think we should separate them into two classes here. One being exploration, pre-resource. So really driven by the drill bit. The other still being resource, but maybe early stage economics, but quite frankly, these guys aren't building anything. They are going to still be dependent on drilling, but also on the market. And valuation wise, I want to focus on the ones with resources because it was about 2 years ago, we were talking about ounces in the ground being valued at $5, maybe $10 an ounce. Now we're seeing ounces in the ground at even early stage initial resources, some around $50 an ounce. But there's still a number of these resources that are still in the, let's say, $10 to $15 an ounce range. Where's the discrepancy here? What do you think makes these companies valued at more? And do you see an opportunity in these ones that haven't been revalued? Or do you think the ones that are currently being revalued worth more ounces in the ground right now that they still have room to run?
Yeah, I think they have more room to run. Interestingly, we're starting to see some consolidation in the silver stocks, those that are actually operating companies. And that market, obviously, from the metal standpoint, has yet to move. I think that we just haven't been far enough down the road. We haven't seen the majors go in and start shopping yet to any great degree. And once that starts, then those companies are going to take off. And I think that's just what investors are looking at. If these stocks go from being valued at $10 an ounce in the ground to $13 or $15 an ounce, well, considering the fact that typically in just a normal bull market, not even a euphoric bull market, those ounces would sell for $100, $150, even $200 an ounce. There's enough upside remaining that people feel that they have time to wait to get involved. But once you see some significant movement in those companies, then people will come in, investors, speculators, traders will come in and grab them before they move too far. And there's a lot of those out there. So it hasn't started yet, but we will see, I think, with the first big transaction, the first time a major comes in to try and stamp up one of these resources, I think we'll see the starting gun fired and they'll all start to move up very quickly.
Yeah, it is interesting, Brian, that we're not seeing more M&A considering the metals backdrop, considering how cashed up the majors are and the big mid-tiers as well, and considering that a lot of these development stage companies with resources still are at really attractive valuations. If they want to buy them cheap, this is the time to strike. But you brought up silver stocks. I want to ask you about the silver stocks. There's a lot of people that have mentioned on our show in the last week or so, they're getting excited about silver. And to me, it's a bit of a head scratcher, Brian, because silver got up to $35 last year in October, and there was a pretty good rip in the sector. Of course, that was followed by when Trump won the elections, there was a sell off in the precious metals at the end of last year. But just in March, silver hit a higher level. It got up to 35.40 at an intraday level, and it closed one day at 35.08. So the highest level it had closed at since 2012. And there wasn't hardly any excitement. I was looking at SILJ last night, just looking at the chart, and it actually made a lot lower high than it did in October of last year. But then silver is now back up in the 32, 33 range, and people are getting excited about silver now. Why weren't they excited about it in March? Why is there this delayed effect in silver? Why are the silver stocks starting to outperform better now than when silver were at higher prices?
Yeah, it is a puzzle. I really can't say I understand it other than the fact that, maybe that FOMO is kicking in and people looking at what's the next thing that's going to move. We've seen some movement into gold stocks. We've seen some consolidation in the silver producers. So maybe they're just looking at this is the next thing and I want to get on board quickly. But the saying that I learned early on in my career is that gold bugs are, and Jim Blanchard actually told me this, gold bugs are crazy, but silver bugs are effing nuts. So, they really look at silver, and I think appropriately, as a non-expiring option on gold. It leverages gold, and then the silver stocks leverage silver. So if you can get into these companies, these really good companies that aren't going to run out of money anytime soon, that aren't going to have to dilute their share structure to raise money to advance their projects, if you can get into them at these levels, and when they pop, they will just scream higher, and you don't want to miss that train. So if you're deploying money in the sector, there's a lot of opportunities in the gold stocks and even fewer opportunities in the silver stocks. So, it's a smaller subsegment of a subsegment or subsector. So a little money goes a long way. And I think that's what we're kind of seeing, an outsized reaction with just a little bit more funds allocated to the sector.
We are, and that's also going down the food chain. I still argue that we still want to see the big guys continue to run here. More money coming into the sector, not just the money that's already in here starting to filter down the food chain. But Brian, if there are opportunities in the silver sector, there are generally less silver stocks, especially pure play or mostly pure play silver stocks. Any in mind that really catch your eye, or how do you go about isolating which ones are the better silver stocks, whether they're big or small?
Yeah, I think you look at silver stocks, and it works the same way as with gold stocks. The producers, the companies, then the companies that are the developers. They've got resources, maybe some economics, and then the ones that have a good project. Yeah, I continue to like Vizsla Silver. I think that's still at some point a triple or quadruple from here. That's going to go into production at some point, can go into production, and will likely be bought out before it can. I like Aftermath Silver. I own Vizsla, by the way, and I also own Aftermath. So I'm kind of talking my book. I mean, I love the silver stocks, so it's no surprise. Aftermath passed a key milestone, I believe, in de-risking when they realize that they can get the manganese credits from their project, and it's not a discount to that. And so I think that's extremely undervalued right now. I like Hawthorne Resources. Again, I own that one. They can get possibly 100 million ounces or more in a resource just by confirming previous work, previous drilling, and maybe doing a little bit more drilling in Nevada at good grades. So those are three that I really like right now. We just added Silver Tiger. I like that one. I do not own that one yet, but I like that one as well.
Some good names there for people, Brian. It's also 'tis the season to be drilling. We're in the thick of it now, and especially in the Great North in Canada and some of the areas that are more frozen up in the U.S. Have thawed out, and a lot of drill programs underway or getting underway. Any of the drill plays that you're excited about?
Well, that's a good point. Good thought. I like Prospector Metals. I really shouldn't be talking about it because I recently bought a position and want to buy more, frankly, but I really like their M2 prospect in the Yukon. Just some tremendous historic drilling results. They've got the right model with the kind of intrusive model that's become the model du jour. So I really like their target. It's a discovery group company, and they'll be drilling finally this summer. I like K2 Gold. It's had a nice move already. It's another discovery group company. They have a great target. They'll be drilling. I do not own a position in that currently. Who else is drilling these days? Dryden Gold has been doing some great work. Another one that I really like, but for some reason have not found a way to own yet. They have come a long way in understanding the geology and morphology of the gold deposits on their project. It's a very large project. Now they've got a lot of targets and they've got a good amount of money to drill them. So I think they're going to really continue to deliver high grade results. So, that's a good group, I think, right there that are either drilling right now or about to start.
That is true. Lots of drilling going on, and now these companies are all cashed up. Man, we haven't seen this environment in quite a while. Hey, Brian, where the juniors are cashed up, the majors are making money, and people are talking about the gold sector on mainstream media, TV, and we're even getting even more emails and texts from friends and associates saying, hey, this gold sector's really running, must be good. And it is right now. Let's just hope that this momentum continues. Again, driven by all kinds of different factors right now that continue to line up for the precious metals sector. Brian will wrap it up here. Again, Brien Lundin is the editor of the Gold Newsletter and our host down at the New Orleans Investment Conference. Click the link in the show notes. Learn more about the Gold Newsletter and consider joining us down at Brian's conference November 2nd to 5th. Brian, thank you as always for your time today. I hope you have a great rest of your week.
You too. Thanks, guys.